Welcome to our 2024 post-election market outlook. We're certainly excited to have everybody with us this morning. And certainly we've all been watching the events leading up to the election. Election day has come and gone, and here we are, all eager to know what the market outlook might be. And in our time together today, we'll be diving into some insights and perspectives on the election and the impact it'll have on the market and the economy. So we're happy to have Bob Carey with us, who's with First Trust, a trusted partner of our Pulse Financial Services, and delivering this update. So we're excited for all that. Bob Carey is their chief market strategist, super smart guy. Of course, we've had him out to a few different events and always appreciate his insights. So we have roughly 40 minutes of content that he's going to be presenting, and then we'll have some time for a question and answer at the end. So with that, I'll pass it off to you. Welcome, Bob.
Thank you, Andy. Good morning, everyone. We appreciate everyone spending a few minutes with us here today. Certainly a lot of things going on. Obviously, we've had significant events that have impacted financial markets over the last couple of months, not just the election. I'll talk more about that in a second. But when I made my slides at the beginning of the year, I'm always asked to come up with a title for the slides. And I thought that at some point that we would see a change in a couple of things as we went forward this year. I thought that we would see the stock market broaden out. The market has been incredibly concentrated over the last couple of years on just a handful of names. The so-called Magnificent Seven stocks have been really the main drivers of the stock market the last couple of years. And that was true until the middle part of the year. And I also thought that it was possible that we would see a shift in Washington, D.C. this year. Well, obviously, it's an election year. We knew that there were a lot more vulnerable Democratic senators up for re-election this particular cycle. So it was looking very likely that we would see a shift, at least in the U.S. Senate. And then we'd also see the Fed start to cut interest rates after raising interest rates for a couple of years, basically starting in 2021. We thought that there was going to be a chance that the Fed would start to cut interest rates. And so far, we're 3 for 3 on that. Since the middle part of the year, we have seen an improvement in the stock market's breadth. In other words, the market has been going up, obviously, since July, but it hasn't just been the Magnificent Seven companies. In fact, we were at a point in the middle of the year when less than 20% of companies in the S&P 500 were outperforming the S&P 500 index. You can see that for the most part over the last several years, but especially the last 2 years, the average stock in the S&P 500 has not kept up with the S&P 500. We've been through this before. We saw this back in the late 1990s, as you can see, back in 1998 and 1999. And the one thing about markets that are incredibly narrow is they don't stay that way. At some point, something happens. We see markets broaden out. And that is what we expect over the next several years. And that's been the case since the middle of July or so. We've seen the S&P has gone up, certainly. The Dow's gone up. The NASDAQ's gone up. But it's been the average stock in the S&P. It's been the small caps part of the market. Mid caps have all outperformed the S&P 500. They've actually outperformed even the Magnificent Seven stocks since the middle of July. And so as we wrap up earnings reporting season, we are watching very, very closely what is likely to be the most closely watched aspect of the Trump presidency as we go forward is what happens to the economy. What kind of earnings do we get in the future from a personal perspective, from a wage perspective, taxes, all those sorts of things are very, very important to us as investors. And of course, the companies that make up the market have earnings as well. And right now, the earnings estimates for 2025 sit right here. This is where, if we look at all the estimates for all the companies in the S&P 500, this is what the collective wisdom of all the analysts who cover the companies in the S&P 500 are saying. Now, obviously, if the economy slows down, if the Fed, for some crazy reason, decides to increase interest rates and as opposed to continue cutting rates, a lot of these things could change. But we feel pretty confident that we will see the economy continue to grow at a modest pace. We will see the Fed continue to cut interest rates. And if we get significant legislation at the beginning of next year that gives us more certainty about taxes. We're talking about not just taxes on wages, but taxes on dividends, taxes on capital gains, estate taxes. All of those things have been somewhat up in the air and obviously very dependent upon the composition of Washington, D.C. And I think it looks very likely the Republicans will have control of the House, the Senate, and of course the White House here, at least for the next couple of years. So we are optimistic that we are going to see some changes in tax rates, or maybe we keep the same tax rates, but we have a little more certainty, at least for a while, where these rates are now essentially with us for longer into the future. That's the one aspect of the tax package that was signed into law in 2017, is that they would sunset eventually, would go away. Well, now if we can push further into the future, what we know about taxes, that would be a very, very good thing. The Fed is obviously cutting interest rates. We have seen a little bit of volatility, undoubtedly, in the fixed income markets here in the last couple of years. We are now at the point, from a fixed income perspective, from a bond perspective, where essentially we've got inflation running at about 2.5%. The Fed thinks that inflation will fall to 2% over the next couple of years. We'll have to see if that happens, but we're now at the point where interest rates are now above the inflation rate for the first time. Throughout most of the years following the financial crisis in 2008 into 2009, we had interest rates, and of course, especially during COVID, we had rates that were below the inflation rate. That's not a good thing for investors. For those of us who have savings and we're looking to keep up with inflation, that has been punishing, and that was punishing for a long period of time. And I think we finally have gotten to the point where even if the Fed were to cut interest rates a few more times, I think for the most part they are going to keep interest rates above the inflation rate as we go forward. Obviously, that's very hard to predict. We don't know who will replace Chairman Powell, but I think Powell is he was very cautious in his comments yesterday. I was listening to his press conference after they announced that they were cutting rates, and I didn't get the feeling that they were necessarily in a huge hurry to cut interest rates, too much going forward. Maybe a little bit more this year, but I think the Fed is going to be very careful about not letting inflation come roaring back, which obviously they did. They allowed back in 2021. So we'll see how this plays out. But we've seen some convergence in a couple of things that we look at from a numbers perspective when it pertains to both stocks and bonds. Basically if all the companies in the S&P 500 were to pay out all of their earnings in the form of a dividend, right now that dividend yield in theory would be 4.3%. And as of this morning, the yield on the 10-year Treasury is roughly 4.3%. These two lines have come together after essentially being apart for the better part of this entire century. This is something that hasn't gotten a lot of attention, but if you look back at history, whatever the yield was on the 10-year Treasury going back in time, and if I took this chart back through the 80s, the 70s, you'd see this relationship held up really well. Whatever the yield was on the U.S. Treasury market, the U.S. 10-year Treasury yield, that would give us exactly the same as what we call the earnings yield on the S&P 500. These two lines, as you can see, they broke apart in the late 1990s. Initially, they broke apart. We had very, very high yields from a Treasury perspective. We had low yields from a stock market perspective back in the year 2000. Equities were in other words, very, very expensive. And then, of course, in the years after that, we went through the exact opposite situation. Stocks got progressively more attractively valued, and fixed income got progressively more expensive or lower yielding. And really, for the last 10 years, I think essentially we have been working our way back to what I consider to be more of a normal relationship between these two measures of valuation. So the stock market is at these levels, it is relatively expensive. It is normally from a long-term perspective, this level here at 6% is kind of the average. If you draw a line through this chart, that's kind of where we normally are from a longer-term perspective. But I think what's happening is we have significantly higher earnings and we have higher returns on capital in the S&P 500 companies than we've ever seen before. And I think technology has profoundly changed the way companies run their businesses. We have more technology, of course, in our economy. We all use more technology in our day-to-day lives. And I think companies are much more aware of what is going on at the business level. If investments are working or if they're not working, I think the feedback is much more immediate. And I calculate that the rate of return on balance sheets today for the companies in the S&P 500 is about 10%. So we've seen the Fed raise rates to 5.5% over the last couple of years, and obviously they've cut rates back down to 4.75. Those interest rates were never a threat to larger companies in the economy. Big companies in particular have been, I think, relatively immune from these higher interest rates. And I think that's one of the reasons why the stock market has done so well. Now that we have a Fed cutting interest rates, we have seen the market broaden out. We've seen smaller companies perform better. For the most part, big companies do not need a lot of external capital. They don't need money to grow their business. They generate plenty of cash on their own. So smaller companies tend to need financing. They need uh, capital, in other words, from investors, whether it's through the bond market, whether it's through the banks or the stock market. Smaller companies now have a lower cost of capital here as we go forward. And I do think you're going to see improvements in rates of return on, as I mentioned before, on smaller and mid-cap companies. This has been quite a transformation here in the last 10 or 15, 20 years, but this process has been underway now, really since the internet became part of our lives in the mid 1990s. Companies just simply have better rates of return on investment today than they had a generation ago here in the U.S. We don't see quite the same improvement outside the U.S. One of the questions that I was getting specifically before the election was, well, what if I had people asking me, well, if Trump wins, uh, does that mean that companies overseas become better investments? And it's kind of funny since the election, we've actually seen the U.S. outperform compared to the rest of the world. And I think that that is a reflection of reality that has been in place even before the election. Companies outside the U.S., the rest of the world, in other words, these companies are not generating the kinds of or growth rates or earnings returns that we see among U.S. companies. It really is a U.S.-centric market. Companies have done much better. We simply have better companies in the U.S. And if you look at the relative performance of the U.S. versus the rest of the world in the last 10 to 15 years, we have really run circles around the rest of the world from a stock market perspective. The U.S. dollar in the past, if the dollar was going up, we would see the U.S. outperform. If the dollar was going down, we would see the U.S. underperform. That relationship held up pretty well until about 10 years ago. As you can see, the dollar is a little bit higher than it was, 10 years or so, 9, 10 years ago. But this level continues to go up and up and up. We've seen a decoupling. The dollar is not the main driver of the differences in returns. It's just simply due to the fact that we have better companies here in the U.S. This trend, in other words, is a lot steeper than this trend here for companies outside the U.S. And I don't think that's going to stop anytime soon here as we go forward. Now, I want to talk about a couple of opportunities that I think are going to be very important, I think, as we go forward. I think a lot of investors these days, they have a lot of their portfolios anchored in companies that are in the infotech area, communication services, and consumer discretionary. That's been where the action has been. The so-called Magnificent Seven companies all reside in one of these three buckets inside the S&P 500. I do think that we are going to see a couple sectors perform fairly well going forward. One actually that has performed really well year to date, and that is the utility sector. All the way over here on the right-hand side, for the first time in a very, very long time, we are actually seeing companies in the utility space, especially companies that sell or distribute electricity. Demand for electricity is absolutely soaring here in the United States, and I do believe a lot of that is being driven by the information age that we live in. In other words, data centers are being built all over the country to an unprecedented levels, and with all of the ramping up that we now have going on for artificial intelligence and the like, I don't think this trend is going to stop anytime soon. It's gotten to the point where we are even taking nuclear power plants that have been taken offline or decommissioned, as they say. Uh, there are plans to bring some of these plants back online here as we go forward, and in many cases the demand is coming from companies that operate massive data centers, including some of the biggest companies in the market. So we look at the earnings growth rate here for 2024 in the utility space, and you'll notice that that red line is exceptionally high. This is, very often, if you look at where earnings are going up the fastest, that's usually where the action is in the stock market, and that's, really why we have seen utilities perform well. And I don't think this is something that's going to necessarily be 1 year and done. I think this is something we're going to be looking at for the next 3 to 5 to 10 years and maybe beyond. We have companies actually looking at putting more and more capital to work. And if those investments pay off, you're going to see earnings and dividends go up much faster than what we've seen in the past for companies in the utility space. These companies, I think, are relatively attractive, but I think they are. I don't see anything from this election cycle that will change the outlook for that. The other sector that I think maybe initially will not do very well, but I think as we go forward, I think the energy sector is going to be poised to do pretty well here over the next several years. I think Trump will be much more inclined to reduce regulations to some extent, change some of the policies that we've had over the last 10 or 15 years. The 5-year earnings estimates for companies in the energy sector look reasonably attractive. I think you're going to see some of these companies do reasonably well in this environment. I do think supply will pick up. I think companies that are involved in refining and the like, I think those are going to be winning companies here as we go forward. I think you're going to see demand for products remain relatively stable, and I think you're going to see costs actually going down as we increase the supply of oil hitting the market. And I think you're going to see some companies in the energy space, companies that have big refining operations in particular, I think are going to be big winners. And then going forward, I think this is more the Fed than anything else. I think financials are going to benefit from interest rates shifting here as we go forward. I'm not expecting that interest rates, if you look out at maturities 5 and 10 years as far as maturities, I don't think those rates are going to come down all that much. I think most of the action is going to be on the very short end of where interest rates are set. And I think the Fed will lower interest rates to about 3.5% over the next few years. And I think rates are going to be a little bit higher when you look at maturities 5, 10, 20, 30 years down the road. And I think that bodes well for financials. Financial institutions, by and large, are in the business of accepting deposits and the like. They're typically funded with shorter term instruments, and then they turn around and they invest those instruments in longer maturity investments. And spreads have been, with the yield curve inverted, and the spreads have been under pressure, I believe, over the last couple of years. And I think you will see the outlook for earnings improve for financials. In fact, smaller companies, specifically since the middle of July, have performed really, really well. That has been the best kind of subsector in the stock market since the Fed announced that they would start cutting interest rates. And then over the last couple of days, we've seen further gains in those companies. Financials have been a real winner since the election. And I think that's the market saying that it likes what it sees as far as regulations are concerned. And as we go forward, we should see companies in the financials benefit from what will be perhaps a shift in policy here as we go forward. And the last thing I want to mention, I want to get back to this market broadening out. We have an inside view in terms of portfolios. I know that Stephanie and Andy, you have a lot of clients, and I'm sure you run every portfolio uniquely. We have a service at my company, First Trust, where we analyze portfolios for financial advisors. They submit portfolios. They could be a model portfolio, it could be an actual client account, and we look for what we call gaps and overlaps. We look for, where are you invested? And right now we have a lot of investors with a lot of cash, a lot of money from a short-term perspective. Investors have a lot of liquidity right now in their portfolios. That's more on the fixed income side, on their cash side. And then we switch over to the stock market, and almost all portfolios that we see today, there are some exceptions, but most portfolios have most of their exposure to large cap growth companies. And there's nothing wrong with that. That's been the place to be. over the last several years, over the last, let's call it 3 to 5, 10 years. I think as we go forward, that we are going to see some leveling off of this differential. In fact, I think we'll see outperformance in areas of the market such as mid caps here in the middle. When I look at the analytics, when I look at the 5-year earnings growth rates, and I look at valuations, which is this orange, you can see that valuations are very, very high for companies in the growth side of the marketplace. The large cap growth companies are kind of up here, and everything else is down around here, which is actually more in line with long-term averages. And so, it's really a question of where earnings go over the next 5 years. But if you look at companies, for example, in the mid-cap space, mid-cap growth companies actually have a higher 5-year growth rate projection than companies in the large cap space. And the same thing is true, by the way, for the value companies. And so I think when you look at the 5-year earnings estimates for the companies that make up the market, there's really no reason for companies to lag behind just because you're not necessarily one of the big seven. I think you're going to see better performance here as we go forward. So it's an exciting time. Obviously, markets have done really, really well. Again, this year, it's been a long time since we've had a correction in the stock market. I am often asked, what could cause a market to go down? Obviously, if some sort of geopolitical event were to happen, things like that, if we were to see the Fed not succeed in getting inflation under control, and all of a sudden we're talking about the Fed raising interest rates at some point down the road, those kinds of things would undoubtedly be reasons for investors to basically reassess what's happening in the financial markets. But I think longer term, I think ultimately we have a couple things in place that I think matter the most. I think we are in just an incredibly entrepreneurial place. If you look at the United States, we are the most entrepreneurial country in the world, and you couple that entrepreneurial spirit with essentially the ever-increasing quantity of money in the economy. And it's really no surprise that we have seen the stock market in particular do as well as it's done over the last many generations. This is going back to the early 1960s, and you think about the increase in the quantity of goods and services that we provide and that we see in the economy, and you couple that with more money. I think the long-term performance is very much intact here as we go forward. So one of the things that I noticed, I turned 60 last year, just anecdotally. I turned 60 last year, and I had a lot of friends also turning 60. And what I noticed, turning 60 that I didn't notice when I turned 50, is you can buy birthday cards now for people turning 100. This is really pretty interesting to me. At the bottom of the shelf, there were cards for people turning 100. I'm actually with my mom today, and she turns 85. And in fact, the 85 plus segment of the population is actually the fastest growing segment of our population here in the United States. So we have people living a whole lot longer than they used to live. And I think that from a financial planning perspective, it puts a premium on making sure that you have investments that are going to be there and have upside potential in the event that we are around a lot longer than maybe our predecessors were. So we'll see, obviously, how this plays out. Nobody really knows how long they're going to be around, but I think a lot of folks are going to be retiring maybe a little bit later, but I think that it's possible that they're going to need their money to last a lot longer into retirement than ever before as we go forward. And I think that puts a lot of pressure, and I think it makes it even more important and more urgent to have a financial plan in place. So just something to think about as we go forward. And with that, Andy, I'm going to stop right there, and I'm more than happy to stick around and answer any questions you may have, or if any questions come in.
Great. Thanks so much, Bob. Thanks for sharing your expertise. And I think you hit the nail on the head, and that's what we preach as well, is how important strategy is, retirement strategy, for all the unforeseen events that can occur, like geopolitical events, COVID, of course, a big one, but also the unforeseen events of like, holy crap, I'm celebrating my 90th birthday, my 95th birthday. Who would have thunk like I'd be around this long? So we got to plan for all the unforeseen events. One question that we do often get is like, what's your perspective on some of this like deficit spending that's been occurring as a country with our current debt mountain that we have? Is this an issue? What's your kind of insights on some of that?
Yeah, I get that question a lot, and I watch every quarter the United States Treasury comes to market and they auction off Treasury bills, Treasury notes, Treasury bonds, and the quantity, obviously, of debt that the Treasury has issued has increased quite a bit in the last 5 years, in particular, after increasing steadily for a long time. That those numbers have increased dramatically here in the last couple of years as deficits have increased. If you look at the number of bids that the Treasury gets for what's being auctioned off, those numbers are still at a very, very high level. In other words, for every dollar that we see getting auctioned off, typically there's $2.50 in bids for those securities. And what that tells me is that the financial markets are not worried about the U.S. deficit right now. Now, if we continue to spend at these levels and we continue to have deficits at these levels and issuance goes up and we see interest rates, let's if we start to if we start to price in higher interest rates for longer, then there's no doubt about it that we are going to be tested here going forward. We've been through cycles in the past where we look at levels of deficit spending, we look at interest payments as a share of GDP, and we're not at levels that we saw in previous cycles, but we potentially could be there in a couple of years. And I do think that at that point down the road, will get the attention of policymakers. The one aspect of interest payments is the interest payments are not political. When if you're the government, I don't care whether it's the state of Illinois or whether it's the federal government, when you make an interest payment, those are dollars that cannot be used for other purposes, whether it's defense, whether it's Social Security, all these different things that the government spends money on. That increasing level of debt service will, in a sense, put the brakes, I believe, on spending at some point, or it may result in possibly taxes going up to some extent. We'll see ultimately how it plays out, but we have enough capital to finance deficits of a couple $1 trillion a year. Probably not forever, but at some point we do need this. We need to get those levels down as we go forward. I think the question that I have is how do we think that we solve those issues? If we solve them by keeping spending high, but we raise taxes, we run the risk of slowing the economy down dramatically. If we don't see spending cut at some point down the road, it may be difficult to rein that back in, and we have an inflation problem at some point down the road. So these are things that we're thinking about. It is something that I do think the market is already largely pricing in. In other words, it's already kind of in there. But I think going forward, the one aspect of this election, I do think this election cycle, there is a potential that we will see spending begin to come down. There's been a lot of talk about government spending and efficiencies and the like, and there's no doubt that the potential for very much a kind of a repeat of what we saw back in the 1980s and 1990s under both Republicans and Democrats, we could very well see federal spending as a share of GDP begin to come back down. It has been coming down a little bit the last 2 years, but we're still at 23% of GDP from a federal level. Normally, we're closer to 20 to 21%. So we do need to potentially, or we will potentially see changes in policy going forward. But at this point, it's an issue, but I'm not really too worried about it at this point.
Great. No, thanks for that. And then obviously there's been a lot of talk about like tariffs. What do you see the impact of tariffs having on our economy, on our trade imbalance? Is that a pro? Is that a con? Or how do you interpret some of how that will unfold?
Yeah, I'm not in favor of an across the board increase in tariffs, and I don't think that we will see that. The one thing about tariffs is that the president, in and of himself, he does not have the power to enact tariffs. You do need the cooperation of both the House and the Senate to change any sort of tax or any kind of tariff treaty that you may have with another country. So I think there could be strategic um, tariffs being applied. But the one aspect of tariffs is they are potentially inflationary. In fact, that would be a concern. And obviously, if inflation on certain items becomes a problem, it's not going to be good for reelection. And we were talking about this before the call started, Andy. The one aspect of our system is that we have a midterm election here in 2 years. If I'm in the business of trying to stay in office as a congressman, for example, I don't know that I would be in favor of massive increases in tariffs on certain goods, making things more expensive for my constituents. So I think Trump will um, take some actions on certain products, but I think massive increases in tariffs across the board, I think, are going to be very, very difficult to implement. And I think that's one reason why the stock market has largely ignored that, is I don't think the market is worried about that. But if we start to see tariffs go back and forth and we see increases and we get into a trade war, I don't think that that's where we're going with this. But it is something we're watching closely. But at this point, I'm not too concerned about it.
Perfect. Well, thank you very much, Bob. It looks like those were our final questions, and we appreciate you hopping on with us and spending your time with us this morning, and appreciate your expertise as always. So everybody have a great rest of your Friday. Enjoy the beautiful weather. Have a good weekend, and we'll certainly keep you in the loop as all this stuff unfolds.
My pleasure. Take care.